Good afternoon. Thank you for joining us for the third spring NCGA Sustainability webinar. Today we have Maggie Monist with the Environmental Defense Fund. She is the Senior Director of Climate Smart Agriculture with an emphasis in finance and markets. She will be presenting on the financial sector and how that relates to conservation. Maggie works with farmers, financial institutions, food and agriculture companies, and more to create an agricultural system that generates climate stability, clean water, and secure farmer livelihoods. Monist works to quantify the farm financial impacts of climate smart practice adoption, collaborates with major financial institutions and food companies to develop financial solutions, and identifies policy solutions to facilitate investment and risk management that supports climate smart agriculture. Maggie has testified to Congress on the agriculture finance sector's role in reducing climate-related financial risk and serves as co-chair of Field to Market's Innovative Finance Working Group. You can read more about her report, EDF's reports and blogs on agriculture finance on their business farm finance website. Maggie began working with EDF in 2011. She holds a master's degree in environmental management with a focus on economics from Duke University and a bachelor's in economics and political science from Tufts University. She lives in North Carolina with her husband, 2 children, 2 dogs, and many chickens, where she enjoys gardening and running. Welcome, Maggie, and welcome, guests. After Maggie's presentation, we'll ask you all to join back on camera for Q&A. So I will kick it off to you, Maggie.
Thanks, Rachel. Really appreciate you having me. Let me share my screen. Can you see that?
We see the presenter view.
Okay, that's not what I want. Sorry, guys. Sorry, y'all, I have not had that issue happen to me before. Does anybody have?
If you begin your slideshow.
Geez. I did begin it and then I hid my presenter view, but now it won't go big. Well, here, let me stop for a second. Sorry about that. The whole program is having issues now. Okay, I got it. How's that?
That's good.
All right, here we go. Thank you guys so much for having me. And I know that you already had a presentation on quantifying the farm level economic or financial impacts of climate smart practice adoption. So I'm not going to spend a lot of time on that aspect of our work, but I did want to just have one slide on it. One, to note the collaboration that we had with Soil Health Partnership and the corn growers digging into the farm level economics of many of these practices, called Conservation's Impact on the Farm Bottom Line, which is a great resource available on our website, which I will link to later. And also, we worked with many different organizations, including, I think, some of the presenters you had on previously, to develop a guide for practitioners who are trying to quantify the farm level financial impacts of these practices. We're doing a lot of this work across different geographies with different production systems. And we've also looked at a lot of different economic analyses. And we found that, they're all using different methods for different reasons. And it was a little hard to understand what they all added up to, whether they built up to a larger business case for climate smart ag for farmers. So we developed this practitioner's guide to help anybody who's interested in this do better analyses with the resources that they have. So those are just two resources that I wanted to highlight for y'all, and also mention that where we're headed with farm economic analysis is really collaborating with land-grant universities that have farm financial databases and working to connect data on climate smart practices with the farm level financial database and scale that up. So we're really excited about work we've got going on with the University of Minnesota, and we're also doing some work with Kansas State, and we'll be looking to do more. And this is really important because farm level economics have to guide our overall approach to finance. And I will, beat this topic until it's dead, because if we don't understand, what the costs and benefits and risks and risk reduction is of these practices on farms over time, one, how can we ask farmers to adopt them? Two, how can we develop, financial incentives or tools that help farmers to adopt them? So this is, a really important foundation of all of the work on finance that I'm about to present. So I wanted to start at kind of a high level and talk about some of the trends, both globally and here in the US, that are driving agriculture finance to take a look at climate change and climate smart agriculture. So the biggest, I would say, is, a strong investor push around the world to focus on ESG, which is environmental, social, and governance factors. And that's coming through, in many different ways from different investors. And it's just, an important lens now that investors use to look at anything financial. It's here to stay. But it still, is interpreted in different ways by different investors. And so thinking about what that actually means in an agriculture context is really important for, for us and for the rest of agriculture. Then at the same time, there are also increasingly financial regulators who are looking at requiring climate risk assessment and disclosure. Most notably recently, the SEC proposed a rule that would be for publicly traded companies, which would include some agricultural banks, but in a much bigger way, like the big supply chain companies that, work in the food system. And really what that rule is around is, it flows from the first point. Investors want to understand what they're investing in. They've identified climate risk as an important category of risks to understand. And it's asking these big companies to quantify in some way the different climate risks that they face, like, variable weather, supply chain disruptions from, major weather events, the list goes on, and disclose that to their investors. So it's not requiring that companies do anything in particular with that data other than disclosing it. But that is a major trend that, many financial regulators in Europe are already requiring, and now we're starting to see that in the US as well. And the SEC is the most recent, but other financial regulators have released similar guidance or kind of intent to do something similar. So we expect to see this, throughout the financial system over time. The next big trend, which, folks here are very aware of, are net zero greenhouse gas commitments by major food and agriculture companies. This kind of flows from the previous point as well. Those companies are both trying to reduce emissions and sequester carbon and understand their risks from climate change. Less so in the US, but more so globally, there are also lots of financial institutions setting net zero greenhouse gas commitments. EDF is part of a consortium led by the World Business Council for Sustainable Development called Banking for Impact on Climate and Agriculture, which is a group of global banks that have a significant agriculture portfolio who are plan to set net zero targets and are trying to understand what that means for their loan portfolios. So this includes big banks like Rabobanks, Barclays, BNP Paribas, and more. And in the US, Wells Fargo is a part of that. And in Canada, RBC. So banks are, lagging compared to the movement in the food sector to set greenhouse gas emissions reductions goals, but they are starting to set them. And then, of course, the big question is, well, what does that mean? And what kind of data do we have to substantiate that? And then last, something that I hear a lot from ag lenders that I talk to in the US is around emerging market opportunities for farmers. And usually carbon markets get the biggest billing, but they're also interested in these supply chain commitments. Some of these banks, like take Rabobank, for example, they finance both farmers directly through, typical operating loans and land loans, and they also finance major food and agriculture companies. So they really want to understand the interplay of these different trends. And the report photo on the right is a report that I wrote a couple of years called Financing Resilient Agriculture, which is really focused on agricultural lenders and their role in both understanding climate risk and financing more resilient or climate smart agriculture. So if you want to learn more about what that looks like from an agricultural lender perspective, that resource is available to you. I like using this quote from the CEO of CoBank because it echoes a lot of the CEO conversations that I've had with agricultural lenders. Politics will certainly impact how we ag lenders and other players in this space grapple with climate change and figure out how to, what it means to their business. But they're all thinking in terms of what it will look like, not whether this will happen. That in the CEO's minds that I've talked to, that question is settled. Climate change does impact their business and most importantly, their clients, the farmers, and they need to figure out what their role is in supporting farmers to be resilient and profitable over the long term. And so, as we think about ag lenders, we might want to start with kind of some of the basics. Like if farmers are watching this, one, I think it's important to remember that ag lenders are not allowed to make farming decisions for farmers or tell farmers how to farm. But at the same time, they're still trusted advisors and play an important role in the farming operation. And there are a lot of things that they can do in supporting farmers to either mitigate the impacts of climate change or build resilience. And then there's a lot that they can also do to look at their overall portfolio and make sure that that is lower emitting and resilient as well. So, number one is working on this quantification. This is something where, ag lenders do not have access to the kind of data that we're talking about in terms of really understanding how climate smart practices impact farm bottom lines. And when they're able to see that kind of financial analysis, they really value it. So that's one reason that we're working with the land grants to try to scale up this kind of analysis. Of course, we need to be protective of, growers' privacy in doing that kind of analysis, but this is really valuable information for both the farmer and the lender to better understand what are the conditions under which climate smart practices can be profitable, and what support do they need to ensure that they will be profitable. Second, ag lenders can play this role of connecting farmers with education opportunities, technical assistance, new market opportunities. They talk to a lot of farmers, and so if they're plugged into conversations about climate smart agriculture and opportunities there, they can help farmers access those. They can conduct climate risk assessments to guide risk mitigation investments. Now that's really where lenders have a standard risk assessment process, and they will, test, do different scenario analyses to basically test the strength of their system. You can do that for climate risk by basically importing a climate scenario analysis. So you can look at different potential climate scenarios depending on the geography of the lender and the farmers in their portfolio, the types of production, the type of climate changes that they're seeing. You can do, an external climate modeling firm can do those scenarios. You can then model how that would impact the farm, the farm loan portfolio, and basically plug that right into the lender's typical risk assessment process. Now, this is something that has only been done, I would say, for a few ag lenders around the world. Right now, we're working with the US ag lender to do one here and see what that looks like. So again, even though there's, some kind of regulatory movement towards requiring this type of analysis, the tools and the frameworks are still really not there yet. And so we're focused on making sure that lenders have really solid tools to make good decisions that make sense for their businesses, so that they're able to make sure that they're looking ahead towards the risks that might be facing the farmers in their portfolios and support them in mitigating those risks. And last is they can deliver different products, programs, or policies that either integrate the value of climate smart agriculture or support farmers through the transition to climate smart agriculture. And if anybody's familiar with organic transition loans, that's an example, or of young beginning and small farmer programs, that's another example of where an ag lender can kind of identify a challenge that a portion of farmers are having trouble overcoming and tailor their programs and products to that challenge to support more farmers in overcoming it. So these topics are things we've been talking with many ag lenders about over the last several years, both in farm credit and commercial banks, talking about the potential for products that support farmers through transitions to soil health practices or climate smart practices. And we really wanted to know what farmers thought. It's all well and good to talk about how it's possible to create these things, but we wanted to know if farmers actually wanted them. So we, in partnership with the Nature Conservancy and the Midwest Row Crop Collaborative and Practical Farmers of Iowa, we undertook a market analysis survey using the market research firm Beck Ag. And we looked at a representative sample of 100 Iowa farmers. You can see them all scattered across the map there. You can also see the kind of average statistics in terms of the farm size, the percentage of land rented and owned, and the average age. All of that was intended to get us to, not just our echo chamber of farmers that, we know and ask for advice frequently, but to, a representative group of farmers to get their opinion on this type of financial product. So And this study produced so much good data, and this is also available on our resources hub. This is the first one that I love to show because here it shows that the farmers' opinions really back up the financial data. When we ask the farmers whether they think that soil health practices have these following benefits, here's what we heard from them. We asked them, do you think that soil health and agronomic practices, by which we were talking about no-till cover crops, nutrient efficiency were the main ones we were discussing. Do they improve the environment? Yes. Do they improve yields? Yes. Do they increase profitability in the long term? Almost 90% said yes. Do they increase profitability in the first 2 years? Well, there we only had, 40%. And I would absolutely agree with that. I think 40% is even a little on the optimistic side. And so here, these farmer opinions are really backing up the data that we've seen in the farm financial analyses that we've completed. So after we had asked them about, their perspectives on the practices, about their existing lending, use of loan products, we tested this sample soil health transition loan with them. And we developed this with an ag lender, talking about potential options and that this could be a viable option. And basically what it was is a 5-year operating loan. It would require kind of like annual renewals, but it would be a streamlined process. So it would basically be like, we're in this together for 5 years as the farmer is trying to transition to some of these practices. It would also include more flexible underwriting requirements with reduced requirements for the first 3 years to give them a little wiggle room as they're getting used to this new system. That was the core concept. Then we tested 4 additional incentives: technical assistance, peer-to-peer farmer networking, a 1% lower interest rate, and this was when interest rates were already, pretty low, had not headed back up yet, and also a $10 per acre cost share. And so we wanted to see which of these combinations farmers responded to most favorably. So how you read this graph is the green is the farmer said, yeah, I would be likely to participate. The gray is neutral, like I'm not sure, I might participate. And the blue is not likely to participate. And so as you can see, going top to bottom, when we tested that core concept, just like we're in this together for 5 years and we're going to be more flexible, few farmers were interested. The vast majority were in this, like, I need to know the details category. I'm not sure about this. Then it got really interesting as we started to add in the incentives. And each of these were tested individually. So each of these is just the core concept plus technical assistance. So that got us up to 20% of the farmers wanting to participate. Then the core concept plus farmer networking, that got us up to 1/3. The last 2, the financial incentives, were where we got to 50% with either one of those. So we think that's really notable that with either one of these financial incentives included, about half of the farmers said they would be interested in participating in these. That shows, pretty substantial market demand for this kind of concept, which most of those farmers, had never heard of prior to this conversation they were in with Beck Ag. So, of course, EDF works with a lot of different companies, farmer organizations, and also finance providers. And it's one thing to do a survey and ask farmers if they want something. It's an entirely different thing to actually test something in the marketplace. And so, we are hoping that, many different finance providers will begin to have offerings for farmers that allow them to either get a better deal or get more support as they're adopting these climate smart practices. But the first out the gate is this pilot operating loan fund that we developed with Farmers Business Network's finance group. Most people are probably familiar with FBN. They started as a data company. They have an inputs business. They also have a finance business, which started, I think, in 2020. So it's more recent, but it's a separate, arm of the company. And they do your regular, operating loans, et cetera. And so EDF was already working with their data platform to integrate some science into that data platform so that they could track environmental benefits, if farmers chose to opt in and share that data. And so all we did was we married up their data platform Gradable with an operating loan and said, okay, farmers, if you meet these environmental standards, which I'll go into in a second, you get a 0.5 percentage point off of your operating loan. So it's pretty simple. It's just if you meet the standards, you get a 0.5 percentage point off of your operating loan interest rate. Doesn't matter if you've been doing it for 20 years or you just started, as long as you hit the standards, you get this benefit. And they started with a $25 million pilot fund, which we launched in January. And so here's just how it kind of functions throughout the system. First they do an eligibility screening with the farmer. It's only for grain farmers, so corn, soy, and wheat in the rotation, but otherwise very flexible geographically in the US. Before planting, the farmers submit 3 years of historical data on practices to Gradable. And then after harvest, they kind of finish submitting their data to Gradable. And if they did, in fact, meet the environmental standards, they get their interest loan rebate. If for some reason they didn't, something happened, they had to add more nitrogen this year, they weren't able to meet that standard, they've still got their underlying financing, which the rates are pretty competitive with other ag lenders. They just don't get the rebate. So here are the standards. Eligible crops, soil sampling, the two that are most important. We were really trying to get to something that would be robust environmentally, but also really flexible for farmers in different circumstances to be able to participate. So there's a soil health standard, which requires basically at least one soil health practice, no-till, cover crops, some combination, on at least 70% of farmed acres. And then there's a nutrient efficiency standard that says 80% of the fields need to achieve a nitrogen balance score between 25 to 75 pounds on a 3-year average. And I'm going to tell you what that means. So I think most people are used to thinking about nitrogen efficiency, which is basically, your amount of N by your yield. And so you would divide there. Nitrogen balance is just a subtraction. It's really very simple. It's just the nitrogen added to the field minus the nitrogen taken off by the field. That kind of excess chunk is nitrogen balance. And EDF and other scientists have done a lot of work that connects that single extremely simple metric to both nitrate losses to water and nitrous oxide emissions to air. So what's cool about this is that we don't have to use a really complicated model. We can just use very basic data from the field that the farmer should likely be collecting anyway and actually quantify that environmental outcome. And what we found is that there's this safe zone of nitrogen balance. You don't want to be at 0, which is basically you take, your crop takes off exactly as much as you put on, because then you end up mining soil nutrients over time. But if you're up really high, that's when you start losing a lot of nitrogen to the water and air. So there's this safe zone identified by our scientists and others, where if you're in there, about 25 to 75 pounds extra in nitrogen balance, then you're not losing a lot to the environment, and you're also continuing to, maximize your productivity, and you're not mining your soil for nutrients. So that's, those are the two things. One is you got to be doing a soil health practice, and the other is you need to be in the nitrogen balance safe zone. So When FBN marketed this to the farmers in their network, we were really excited to see that farmers, were in fact in the real world interested in this. So for the initial $25 million pilot, 48 farmers enrolled, fully enrolled, and now there's a growing wait list. Over 18 states. That made me really happy to see that we did hit this mark of getting a flexible enough environmental standard so that somebody from North Dakota and somebody from North Carolina both could participate. It was also really interesting to see how big the variability was in the farm size and the loan size. The farm size ranged from 500 acres to 7,000 acres. And the loan size went from 100K to 2 million. So again, I think it's pretty cool to see that this was something that was useful to a wide array of grain farmers in the US. And, now we're really excited to see what we can learn from this. First, as I said earlier, the vast majority of agricultural lenders do not have the kind of granular data that is available through the Gradable platform. That revolution just has not hit ag finance yet. And so the ability to really link the environmental and financial performance of the fund and of the farms offers us this opportunity to unlock financing at scale for climate smart agriculture. We're excited to learn a lot. And I just put out a blog on the enrollment, and I hope to continue to do that as we hit these kind of milestones in this pilot project, where we're just really sharing what we learn with everybody else. So we'll find out, how compelling is this interest rate incentive for farmers? We'll be able to calculate the climate and water quality impacts associated with farms in the loan fund and compare it with similar groups of farmers from other bigger data sets. We'll be able to see how the fund performs financially compared to other farm loan funds. And on all of this, it's really important that I make the caveat of course, EDF is not seeing any farm identifiable data. We're not getting access to farm financial data. There's a firewall there, but we are able to help analyze the aggregate financial and environmental data and pull out these lessons for others to learn from. And we hope that, other ag lenders especially are the folks who are learning from this opportunity. And so one other resource that I wanted to mention to y'all is work that I've been leading with Field to Market that Rachel mentioned, co-chairing their Innovative Finance Working Group alongside Shelby Myers from American Farm Bureau. And here we wanted to understand the array of potential financial mechanisms that could help farmers adopt sustainable practices. So you can see one blueprint that I put up there for a crop plan-based warranty product, which is basically a risk-sharing tool for farmers who are changing their practices. And especially if you're worried about crop yield risk, this helps mitigate that risk. There are actually 12 different blueprints that we developed as part of this. They're all in that report. And it also kind of guides you through how can you know which of these tools might be right for the farmers who are trying to make some sort of change that you're working with. And so this is a really nice resource for somebody who's interested in ag finance but maybe doesn't really know where to go, or hears about something that sounds cool but doesn't really know what it is. This really tries to break it down for you and be used as kind of a reference guide to understand some of the different options that are available. And so last, just wanted to mention that you can find all of the different resources that I shared on our Agriculture Finance Resource Hub. We've got a section for finance professionals. We also have a section for farmers and their advisors, as well as one for policymakers. So really trying to make this information available to everyone. And of course, you're also welcome to reach out to me if you have any questions. Thank you very much.
Thank you, Maggie. Now I will invite everyone to come on camera for the Q&A portion of the webinar. So, anyone have any questions?
I'll go ahead and start off with one for you, Maggie. You talked about the risk assessment models that were out there kind of being run right now. Are you aware of, or is it baked into those models what the risk would be on degradation of soils, like if growers were not doing these practices already? So it's kind of, it leans into the additionality space, but does that risk assessment swing both directions on these practices?
That is such a good question. And one is, nothing's final right now. This is still very much like a let's develop tools that work for agriculture. So that might actually be something that I would suggest, if it's not currently included, should be included. But the ones that I'm aware of, it's, there are these kind of climate modeling firms. And so they can develop different climate scenarios. So that would really look like, okay, here I'm in North Carolina, things are getting warmer and wetter. My driveway is flooding out a lot more. Like these are the things that I'm noticing. Folks I know who farm are having trouble figuring out like when to apply their fertilizer and their herbicides. So basically, that climate model then would be matched up with likely impacts on production. And so I think that's where soil degradation could potentially come into play. Then that's matched up with, okay, how is that going to affect the ability to repay the loan? And that's where basically like the external support developing this climate scenario and production impacts goes over to the lender, who then looks at, okay, how does this impact our, typical risk assessment process? So, they already run like other kinds of scenarios. This just is kind of a more specific climate facing scenario that would allow you to look at, a more detailed example of risks that they might face under those circumstances.
Hey, this is Rodney Williamson with Iowa Corn.
Hey, Rodney.
What do you think, what's the bank's attitude? You kind of alluded to it, but what are the lending institutions' attitude about this? 0.5% of interest might be a big deal to some of them and may cost them a lot of money. How are they viewing this?
Absolutely. And that, that 0.5% is something we agreed on to test with FBN Finance. We're definitely not saying like, that's the number that it has to be. So I would say banks' attitudes towards this are complex, just like, anybody, like farmers' attitudes towards this are complex, right? They're kind of pros and cons, and there's an array of different banks. I would say, one, they definitely understand that climate change is, in many cases, negatively impacting farmers who have loans with them, but in some cases, positively impacting, especially in those northern regions that are growing things that they haven't been able to grow before. They are thinking about risks, but don't necessarily have the data or the frameworks in order to really assess those risks. So they understand that data and having good information is something that they're really focused on, both on the risk perspective and on the climate smart practices perspective. So, many lenders, of course, they already finance these practices, right? Like farmers who do cover crops already have operating loans, and those practices are being financed as part of that operating loan. However, the kind of explicit potential value of that is not teased out in any way. You know, if you think about like a long-term land loan, you know, I would contend like it should matter if the soil is being managed in a way that's maintaining that long-term value of the land or if it's not. But right now, like that's not something that they have the data or insights to look at. So really for them, it kind of all comes back to we're trying to figure this out. We're looking at different sources of information and data. How is this going to affect my clients and how can I support them? And so there are, I would say there's, you know, a strong handful of lenders who are looking at like different potential products that could offer some more flexibility or support to farmers. Another thing I'll mention is that like often when I talk with lenders, they'll say like, oh, well, yeah, you know, we already do this. We already make special accommodations for farmers who are doing XYZ. And, you know, I'll say, okay, well, like, do you let other farmers know about that? And the answer is always no. And I kind of joke around with them that it's like the secret menu. Like if the farmer like really, you know, has their financials together, you know, is a really strong operator, wants to do something ambitious environmentally, goes to their lender, like, yeah, a lot of times their lender will work with them. But again, like that will only benefit kind of the folks who really have it all together, not the folks who might need a little bit more help figuring this out. And so we're really trying to transition, you know, some of the things that have worked for like a few farmers into things that are more available to a broader array of farmers. That was a very long answer to your question, but I hope you give that a flavor, that gives you a flavor of the kinds of conversations I'm having.
Yeah, it does. Because to somebody, there's a cost to this, and I just wondered how willing, you know, those who are paying, how willing are they to pay? And I think you answered it well, so thank you.
I think nobody, very few folks want to just cut a check. But if there is real value that's going unrecognized, they want to understand that. And so that's really where I'm focusing. You know, is there longer term profitability benefits that are currently going unrecognized that we can proactively recognize and support? And I think a lot of times, like you talk to lenders and they're like, yeah, some of our best customers, like our most financially stable and savvy customers, they already use these practices. And it becomes a little bit of like a chicken and an egg question, right? Like, well, can we say that these practices are causing that financial stability? Certainly, they're not the cause of all of it, but they can contribute. And so it's kind of like teasing that out and trying to recognize that value and reward that back to the farmer who's the one making the actual investment.
Have you been able to reach the lenders that are not necessarily national companies? I know a lot of our growers work with smaller local banks, and so they're getting their operating loans through them. So is that a conversation that you're having with that group of lenders?
That is such a great question, Rachel. And, you know, as you may know, like roughly 40% of ag lending comes from farm credit, roughly 40% comes from commercial banks. Of that commercial bank sector, like we've got a few big banks, but the vast majority is from that smaller local, regional, or community banks. So you're right that that's hugely important. And those banks also like don't have the staff capacity to spend a ton of time thinking about this in the way that Rabobank has like 1 million analysts working on this all the time and figuring out what they're going to do. So that has been something that I've been thinking about a lot. We've interacted with some of the banker associations like ABA and ICBA that allow us to get more of that perspective. Also in our work with the University of Minnesota, you know, they've got the FinBin financial database, but they also have the FinPac lender software that's used by ag banks. And so we're thinking about like through that network, can we offer, better information or, tools to those banks? And ultimately, I think, maybe what needs to happen is some kind of like opt-in opportunity for them or something that's more standardized and that they could just like pick up and run with if they so choose, rather than like trying to get every small community bank to come up with their own sustainability program. So that's kind of like where I am in my current thinking on that, and would love to brainstorm with you on it if you have any other ideas.
Okay. My family is one that does works with a local bank, so I may go back to them and just see what their answer is if they do that. Consider it, or even if they're, it's on the special menu depending on who you are and how well you take care of your finances. So
Yeah, and like how I would have that discussion is like ask them, are there any examples of how they financed farmers who are using these practices? Are there any examples of how they've, made accommodations or done that in a flexible way? A lot of times, like banks have these kind of like bright spot examples they can share with you. And then the next question is like, okay, well, how do we make that available to more farmers so that it's not just kind of like the chosen few who know to ask for it?
Maggie, quick question on the specific program you have with FBN. So FBN, obviously, they have this $25 million operating pool in this. Now, their benefit for this is that this obviously shows some level of ESG activity, to shareholders or to members of FBN. So there's a marketing, there is a play on that. Is that all that they're getting out of this at this time? Because I guess the question is, if the growers are doing these practices, are they still open to market it to different kinds of possible carbon markets or water markets or something like that? There's no restriction with this?
Yes. That was kind of two questions. I'm going to speak to both of them. So one is, yes, it's designed to be stackable. Nobody's getting credits from it. In fact, in this first pilot, we're not even trying to quantify soil carbon. We're just measuring the nitrous oxide emissions from a climate perspective. So yes, the idea, and this is in our climate smart commodities proposal, so if it's funded, we'll show it in real time, is that the finance can come alongside the other incentive, the cost share, the technical assistance from the supply chain or the carbon market, and the farmer can bring those two together and move forward. On the question about kind of like investment in this and like what FBN's getting out of it, so they're hoping to scale this up with institutional investors who are, looking for a green product and are offering a bit of a concessionary rate. And they're doing that work right now to find those opportunities. And like, if you'll allow me to kind of like take a step back and talk about kind of like my theory of change around this, for so long, there's tons of investor interest in agriculture, right? Like agriculture is like kind of cool right now. People are really into it. Investors want to get in there. But when they look for actual opportunities, they seem to either go into like farmland investment funds where you're actually transacting the land, or, they're investing in companies that want to sell stuff to farmers. And there's this huge middle space of like, how do we invest in the farmers themselves as they're trying to change practices? And there was just nothing as far as I can see. And some of that is because like kind of the tricky economics of the practices, right? Like there's not a 20% like return when you're adopting cover crops. That's just not, that's not a thing. So I see this like opportunity around loan products and risk sharing products as a way to get some of that investor, at least like reasonable investors, not the, super high targeting investors, into like, are we investing in the farmers themselves who are trying to change these practices and give them the resources they need to do so?
That's a great, good answer. Is there any others out there?
Well, thank you,
Well, I'll just
Maggie.
say, yeah, I really appreciate the opportunity. I certainly don't have all the answers, so if anybody has questions or wants to follow up or talk about, specific instances, like Rodney, I'm talking with a lot of folks in Iowa, would be happy to have an Iowa side conversation with you. Just really appreciate the chance to share where we are now. And hopefully we can all move together to find some stuff that really works for farmers.
Yeah, tell you what, Maggie, I know you've been working on this for a long time, so definitely congratulations on getting this one off the ground. It's been a while, but when I saw it announced, I was really encouraged and really happy to see the news. So this is fantastic. We can't wait to see what the results are.
Thanks very much.
Well, thank you, Maggie, and thank you for attending. This has been recorded, so it will be made available by next week for you to listen if you want to hear it again. Thank you.
Thank you.
Thank you.